I've used this, we're going to go on to the economy. I've used this before because this is a really good illustration to show you how QE has been pumping up the stock market. QE, quantitative easing, is nothing but money printing and exchanging that brand new currency from the Federal Reserve to the Wall Street banks in exchange for worthless assets that are still sitting on the Fed's balance sheet. So they had bad assets that were non-performing. The Fed gave them 100%, in some cases, from a recent video that I saw, where it went down the paperwork, showed you that they got over 100% of the face value of these assets. The Federal Reserve then hands Wall Street a check for new currency, printed out of the air, and when they do that, the Fed's balance sheet expands. There's more equity because the Fed owns the dollars that go out there, and there's more receivables on the other side, so it expands the balance sheet. So this is what's been going on. Now this only goes up to 2013. This shows you back in 2008, 2009, this is the S&P. Remember that big, long slide down, the S&P, the Dow, and everything else. When you get down to the bottom here, then Lehman Brothers bankruptcy right here, Bear Stearns is right in here. So at the very bottom, and now look what interest rates. This is what happened today. Brand new information, hot off the presses today. We've had 0 interest rates, target interest rates, all the way from 2009. So this is the 6th year of 0% target interest rates. That's what this is. Now, this is money printing here. This is, TARP ran out back in here. We gave them $700 billion, that didn't do it. Because at the end of $700 billion, they still can't get it to go. So here it is, we start printing money, handing money to Wall Street. Wall Street then starts buying stocks. See, Wall Street is sitting in there with excess reserves. All this money that's being given to Wall Street is sitting not necessarily at Wall Street, but it's sitting at the Federal Reserve. It's excess reserves. They gave the money in exchange for worthless assets, and this money is sitting there at interest. See, the Fed is paying interest to the Wall Street banks to hold this currency for them in the amount of $2.6 trillion right now sitting on the Fed's balance sheet that they're receiving interest for. But they're not loaning it out into the economy. See, they're supposed to take this money and loan it into the economy. Why is the economy dying? Because the banks are not loaning this money into the economy to be used to fuel the economy. Probably they don't think they're going to get it back because the economy's in the tank. But they are receiving interest on it. But anyway, so here QE, we see the S&P climbing, gets all the way to the very top, and all of a sudden they said QE is going to run out. Well, everybody starts selling stocks. Well, down here at the very bottom, then the Jackson Hole speech happens right here, where Bernanke said, we're going to do another round of QE. Well, look, that was at the very bottom. All of a sudden, boom, 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 you start climbing the ladder again. So all this money that's being printed out of the air is going directly into the stock market, because once they have these reserves, the rules of banking allows for the banks to then take that and multiply it by a factor of 10. So this $2.6 trillion that is sitting on the Fed's balance sheet, it can be multiplied to $26 trillion, and they can use 9/10 of that and invest it. Back before 1999, they had to loan it out. But after 1999, when they passed mine's not working. They passed a bill that removed the requirement that the banks had to remain banks. They were then investment banks.
Is it correct to say that approximately $20 trillion is kind of like worthless fiat money?
That what?
That's kind of like worthless fiat money?
It's just, yes,
That it
computer
really doesn't have a
keystrokes.
value to it?
Yeah, it's just computer keystrokes.
Right.
Yeah. Yeah. So in 1999, the banks became investment banks, so they didn't have to loan the money out. They could instead invest it in stocks. So that's what they've been doing here. And they've been pumping, you can see, every time that QE would run out, the stock market would begin to tank. So here it again, they start up QE2, then Operation Twist. They kept QE going up until November of 2014. This gets really interesting. Now this is the S&P. Correlation between the Fed's balance sheet and the S&P 500 has been 89.7% since 2009. This takes you up to September of 2013 here. So you can see that all the money being printed and given to banks is going into the stock market, pumping up the stock market. There's a direct correlation here. That's not the only correlation we see here. All right. Now this was in November of 2014. This is when the Fed said, okay, we're going to stop QE. Oh my gosh, the last two times that they stopped QE, the stock market tanked. So here it is, the stock market's going, wait a minute, what are you going to do here? But just coincidentally, last week, as the Federal Reserve officially announced the end of its long-term asset purchase program, commonly known as QE3, the Bank of Japan significantly ratcheted up its own quantitative easing program in a surprising 5-4 decision. Okay, you think, well, what does that have to do with the stock market and all that? Well, I'm going to show you that too. This is the last 3 months. This is a correlation between, excuse me, that's 2011, 2012, 2013. This is when, this is the value of the US dollar. You know, the US dollar has been climbing extraordinarily over other world currencies. The dollar is very, very strong right now. I'm going to show you why. See, this is the value of a dollar from 2011, virtually horizontal, up to the point where we stopped QE. Well, what happened then? The Japanese started up QE. So we got a hinge point right here in October of 2014, where all of a sudden the value of the US dollar starts going up. You think, well, now what has that got to do with Japan and Japan's central bank printing money over there? It has a lot to do with it, because there's a correlation now between the value of the US dollar. It's just like they hand off the baton. It's like you're in a long race here and you hand off the baton to the Japanese. So politically, you couldn't just keep printing money over here in the United States, because sooner or later people are going to go, wait a minute, you can't just keep doing this. So they hand off the baton to the Japanese. And what clued me into this, personally, I think it's divine inspiration. That's all I can think of, because, you know, I just keep this stuff in my mind all the time. But back on August the 24th, that was Black Monday. Remember the day that recently the United States, the U.S. stock markets plummeted 1,000 points by like 9:35 in the morning. They had plunged 1,000 points, but then by the end of the day, it had climbed halfway back up. What on earth? So I just got thinking about that, and all of a sudden, some thought came to my mind: check the U.S. dollar. So I did. So this was on. This is just recently. This is on September the 9th. That morning, the stock market opened up. Stock market is the red one here. This is the S&P. Opened up, and it was just plummeting. It was going down like it was going out of style. All of a sudden, until 10:30, all of a sudden, it stopped, and it started going sideways here. So it went down that far. That was it. So something made me go and check what happened to the U.S. dollar at that moment, at that very moment. And this is the U.S. dollar. This is the demand curve for the U.S. dollar. Notice that at that point, on the world currency markets, demand for the U.S. dollar increased. It stopped going down, and it started going up. That indicates the very distinct possibility that the currency necessarily to stop the fall of the U.S. stock markets came from offshore. If it were coming from inside the country, then demand for dollars inside of our country would not affect the dollar index, because that is a measure of the value of the U.S. dollar versus a basket of foreign currencies. I didn't say that. I'm very sorry, but that's what that is the value of the dollar versus foreign currencies. So here it is at 10:30 in the morning, boom, change in the direction of the U.S. stock markets, and boom, a change in the direction of the value of the U.S. dollar on the currency markets. So then I got thinking, well, I wonder if this is just a one-time thing, or is this going on, is this happening daily, weekly, monthly? So I went back 3 months. So this was the date, this is September the 9th right here. I went back 3 months. And this is the S&P. This is the dollar index right here. And you'll see that there is a noticeable correlation between the value of the US dollar and the S&P. There's so many correlation points that I drew lines, vertical lines, connecting these points here between the two. So obviously, the currency being used in the U.S. stock markets is not coming predominantly from inside the country. It means that the currency, because it's affecting the value of the dollar relative to other currencies, it means that these people that have these other currencies are having to bid up the price of the dollar at the same time that those dollars are then being used to put into the stock markets. That's what's going on right here. So each one of these correlation points is a definite point that indicates that the currency being used to pump up and to regulate the value of the U.S. stock markets is coming from offshore. Yes, sir.
And their money is being devalued, so they're giving us IOUs for our IOUs. And is that what Trump's talking about with China devaluing the dollar?
I'll talk about that. That's a good point. See, when the Japanese, because that's who I figure is doing this, because they said that they were going to do that. What are they going to do with all that money? Well, they're going to keep buying up U.S. stock. They're going to keep manipulating the U.S. stock market with funny money. So what happens is, early in the morning, normally about 4 o'clock in the morning, if you trace this out, all of a sudden there's a spike in demand of the U.S. currency. Well, that's when the Japanese, I think, are buying their daily quota of dollars for the day that they plan on using to, coordinating with the Fed, to manipulate the price of the U.S. stock market in here. Now, recently, there was a big to-do about China devaluing their currency. You remember that? It's like, I don't know, 4 weeks ago. China has had a huge drop in the Shanghai index. It's like 40% at this point. Well, so the Chinese devalued their currency with respect to the U.S. currency. But what's been going on? If you took the value of the dollar all the way back, you'd see, I've got a slide for that. You'll see that the value of the U.S. dollar has been growing. And the Chinese yuan is pegged to the U.S. dollar. So as the value of the U.S. dollar goes up, then the yuan goes up. But it keeps going up because the Japanese keep buying it to pump up the stock market. So everybody came down on China for devaluing their currency, but they had to devalue it because they're pegged to the dollar. So I don't necessarily blame the Chinese for devaluing their currency, because it was causing their stock markets to go haywire, because the value of their currency, people couldn't afford the currency to buy the Chinese stocks, if that makes sense.
Well, the Chinese market, I mean, the economy has been in
Absolutely.
freefall.
Yeah, absolutely.
This is the reason they have
Yeah.
the value.
All of that, yes, all of that is starting because of the demand for Chinese goods. But it was accentuated, it was amplified by the fact that the Chinese currency was pegged to the dollar. Both were rising, so the Chinese had to devalue it just to get back to where they were. So I don't necessarily think that they did anything wrong when they devalued their currency. Lucretia?
Can the government keep doing this? And if not, when are we going to be like Greece and Poland?
They're not supposed to be doing this. These are criminals.
So what's going to happen to us, the citizens of the United States, when all this comes due and it goes poof?
That's a good question. Yeah, that's a good question. Part of my purpose of telling people this stuff is so that they can prepare for what might be coming their way.
Unsustainable.
But these are criminals that are doing this. They're not supposed to be doing this. This is unlawful. It's a violation of international law. It's a violation of the Federal Reserve Act, everything else you can imagine. The Security Exchange Commission ought to be coming down on the Federal Reserve like white on rice. But you know how that works. The Fed owns the money. And so the Fed can do whatever it needs to do to get it in the right hands to where that doesn't happen. All right. Paul Craig Roberts, who some of you may know who he is. He's former Secretary of the Treasury under Reagan and a former editor of the Wall Street Journal. Very elitely qualified individual to be speaking on these matters. Was talking about all this. He didn't have all this, but he had an interview, and they were asking him a question. If this is being manipulated, can they just keep doing this? Because he expressed that I wouldn't have thought that the Fed could keep this thing going as long as it has. So he goes, I honestly don't know if they can just keep this going forever or not. Have they created a perpetual motion machine where they can just keep printing money out of the air and just keep the stock market pumped up? And they just, well, this analysis is not 100% complete, but I went back. This is just what it looks like to me. Going back for 3 months and looking at the U.S. dollar and the S&P, and this is the same correlation, Japanese or whomever. It has to be a central bank because they got to be able to print money out of the air to do this. You're not going to just take money out of your pocket and you purposely lose it on Wall Street to try, and you don't have this quantity of dollars. You can't just sit at a computer and create the money that it takes to manipulate an entire stock market. But you'll notice this, that the U.S. dollar and the S&P with respect to the value of the U.S. dollar is getting heavier. That's what this tells us. It takes more dollars to keep the S&P up, to keep the other indexes up, and they will run out of dollars. The reason why the U.S. dollar is so strong right now is because it's relative to the currencies that are buying those dollars in order to keep this thing going. Well, the more currencies that they use to buy these, then the less it's all worth. And so with respect to the stocks, the stock markets, to me, I believe they're getting heavier and heavier with respect to the dollar. So I don't think that they can just keep doing this forever. John.
David Stockman, you're familiar with him?
Yeah.
Okay, he's got a pretty good website, and I'm familiar with Roberts. But Stockman's saying the same stuff as Saul. And of course, the Fed decided again today to not move rates.
Absolutely.
So we're going to be zero for what?
Absolutely. I want to read you, speaking of today, I want to read you what I posted this morning on my Facebook page. With respect to today was the day where they were going to raise rates. They haven't raised rates. It's been zero since 2009. Yeah. Whether they're going to raise rates or not. This is what I wrote this morning. I said, if the Fed announces no change, that could make investors pile into the market until they realize that the failure to raise is an admission that they are putting money into a bankrupt system, at which time a convulsive response downward may occur. That is exactly what happened this afternoon, if you're watching.
Look at your divergence.
Yeah,
That's
well,
selling.
this
Also,
afternoon-
S&P is being sold, that's the reason it's going down.
Yeah, this afternoon, what I said this morning is exactly what happened. Because at 2 o'clock, the Fed came out and said that we're not going to raise rates. The Dow went up 226 points, and all of a sudden went down 240 points. Because the people that bid it up, they probably sat there and go, what are we doing? They just told us the system is bankrupt, And we're buying into it?
It's a dead cat bounce.
It's a dead cat, yeah. Well, it's an inverted dead cat bounce, so. That, I don't have the, you had asked about the last 3 months. But anyway, that's just to tell you the truth, which is what we're all about right here. Something really crazy is going on with the U.S. stock market. And it doesn't just drop 1,000 points and then come back up 500 points on its own. That just does not happen. So beware. Beware of what is going on with your finances, because I know that the entire country, even if you don't have money in the stock market, but where you do have money, they've got money in the stock market. So you've got to make sure, and I don't know there is a good way to make sure. So Paul Craig Robertson was asked, well, what should people do with their money? He says, I don't know. See, because they have so suspended reality. They have so distorted the markets that if you get really informed and you make good decisions, you're going to lose money because it's all being manipulated. So that day that the Dow went down 1,000 points, all kinds of people were buying, were selling, and I want to show you another thing about that. You know what this shows me? This shows me the very distinct possibility that all of this was planned, that Black Monday was planned, and I'll show you why. This is the S&P. This was that Friday. You see, it went down that much, then we had the weekend, and then that Monday, it plunged again. And this is where all the people were selling, they were panic selling, but they only got down so far, and then they started buying US dollars and pumping it back in. So what this allowed, and notice that the value of the dollar across here was kind of the same. So they sold the dollars here, they sold the stocks, they sold the dollars that they received in proceeds, and then only down to this point. All of a sudden, they started buying stocks again, but they bought in at a lower buy-in. Their basis was lower because of all the panic selling. I think it's very distinct. If they're going to do this kind of stuff anyway, this is exactly what they would do. They did that to get so many people selling so that they could then buy in at a lower basis. Their buy-in for the same stocks that they held up here was less. So they could start off again at a lower point and start it all again. And you'll notice that in the past, well, since then, the stock market has had some ups and downs, but recently it's had some ups. And I'll say this too, which defeats some of this. This correlation that I'm showing you right here, in the last week, 10 days, correlation hadn't been there. And I don't know if that just means that I need to look at it on a longer basis to be able to see the correlation, or if it's actual domestic demand for stocks. Domestic demand for stocks there would be no correlation between these two if the money's coming from inside the country to buy the stocks. So now, that could mean that the Fed itself has been printing money and it's been going into the stock market. It could mean that the banks sitting on that $2.6 trillion of reserves at the Fed might be taking some of that and buying it. I don't know. But at the same point, all of this is criminal stuff that we're talking about right here. This is you can't have a free market, which is how I got into this Tea Party thing in the first place. You can't just say, we want free markets, and then give free markets. You got to overcome what's not free about it, and this is what's not free about it. So, any questions about that?